Good afternoon, ladies and gentlemen, and welcome to our Cryptoeconomics YouTube channel, where we are trying to explain everything you need to know about investing, especially in the crypto sphere. And we have two separate courses. One is the fundamental analysis, and the other one is the technical analysis. Now, this is the second video of the technical analysis course. As you can see on our channel Cryptoeconomics, you can find them separately. There will be a fundamental analysis course and a technical analysis course. Now, in this particular video today, we're going to be talking about accumulation and distribution phases. I would advise you to take a look at the first video that we already done for levels, as well, where we explain what is the trading view and how we can start using it. And obviously you will catch up so you can follow the course onwards. Now, today we're going to firstly explain what are the main accumulation and distribution phases in one chart. As you can see over here, this is the Bitcoin chart that we're following currently on a monthly level. This is the highest time frame in which we're following this chart. Now, accumulation, as the phrase explains, is an actual field where the practically chart is accumulating the price or where the price is stagnating in a certain level. And distribution is the other way around, where practically we're reaching, I would say, a certain high pitch of the price itself, and where we practically have people selling more than buying. Now, we're going to be marking the lower part or accumulation of a chart with red, and the higher part we're going to be marking with green, which is practically the time where usually people mostly sell. Why is so important? Accumulation distribution phases are, again, psychological behavior of investors and traders in a chart. The red square, as we can see, is the FUD moment, the fear, uncertainty, and doubt, where people generally do not want to invest, speak, or even talk about this particular capital goods. And the other way around, the green one is usually the top of a chart in a certain cycle, in this particular case Bitcoin, where people are only talking about this particular capital good, as in this case when Bitcoin reached around $20,000 in 2017. This is the FOMO, fear of missing out, element of a chart. Now, why is it so important, as we mentioned on the beginning? Usually, traders and investors are waiting for this, I would say, high pitch or low pitch periods of a chart to decide if it's time to sell or buy. The difference between most of the people in the market and the people that are professionals are these charts, these indicators, these formations. And obviously, every high is followed by consolidation and accumulation phase, as well the other way around. Every accumulation phase is followed by distribution and practical top. Now, important part to understand is that if we do have a consolidation in a form of accumulation, does not mean that always have to come a blow off top, practically going down of a chart and distribution phase, but the probability is always bigger than once we have this kind of lowering of the price and accumulation phase where the price is moving in this particular range. The probability is a lot bigger that is going to continue going upwards than continue going downwards. There is always a redistribution phase where this is also possible, and accumulation phase. For example, over here we have a distribution phase, right? But after we had a small accumulation phase, the chart continues downwards. The other way around, we over here we can see a accumulation phase, and then over here where we expected to be a distribution phase, it continued upwards, which means this gives us only a probability that something might happen more than something else. Nothing in technical analysis is 100% full. Now let's find some special areas of distribution and accumulation. Obviously, it's quite easy, especially on a monthly level, to determine them because we're talking about lows and highs of a Bitcoin cycle, and on a monthly time frame, they're quite easy to spot. Obviously, we can see that this is a accumulation phase. Then if we go forward, we can see that this is another, for example, accumulation phase. And as we mentioned before, usually they do move into a particular, I would say, range. That's a very important part of this analysis. So we can see they're actually moving in a particular range. where we have several retest on the top range and several retest on the bottom range before the price finally goes up. There is a logical, psychological explanation about this as well, but this will be explained further onwards when we are doing the second part of this particular formation. That's the Wyckoff distribution and accumulation schematics. But for now, we just need to explain the model. We just to explain how it works for people that are investing and trading. Now, as we mentioned, the accumulation phase we're going to make in red, and the distribution phase we're going to make in green. So we have an idea where the chart was practically reaching the capitulation phases and where it was reaching the FOMO phases. Here we can see as well another, I would say, accumulation distribution phase, which was a bit longer. Now, there is no rule about how long a certain accumulation and distribution phase might last. Sometimes it might be a little bit longer, sometimes it might be a little bit shorter, but generally speaking, it shows you when it's time for the market to move. And again, there is no phase that lasts forever. Every accumulation sooner or later is followed by explosion. Every distribution sooner or later is followed by lowering of the price down. In this case, again, what we can use this for is to determine that after the chart has passed a certain amount of movement into this particular range of low and high, as we can see for several retests, it's probably it's time that probability is larger that is going to move in this case the direction downwards and the other way around. Once it moves into this range for a certain amount of time, in this case doesn't have to be particular amount of time, it's a very big probability that sooner or later it's going to stop going upwards. How do traders and investors use this? When we have lowering of the price, let's say that the bear market started in 2013 and the price started moving downwards, they will not buy until they see that the price has reached this kind of accumulation level where it is moving in a range. Because if it doesn't, there is a big probability that it will continue going downwards. We have corrections on this path downwards, right? But not in a range-bound accumulation phase. We have 1, 2, 3 corrections, but none of them has proved that is going to be the bottom of the market. Similar situation. We have 1, 2, this is finally the bottom and the accumulation range. So it's very important to use this as just an indicator, not 100%, nothing is 100% in technical analysis, for you to know when the market has bottomed, more or less, or when the market has stopped. Same situation here. We can see several tries to go above the top range of this distribution phase. Haven't happened because, again, psychologically, on the bottom part, when we have depression in the market, when nobody wants to talk about this, when everything is FUD, usually institutions are buying. When the price reaches new all-time high, usually, and it's a very high, then the retail market starts coming. What do we have here? This distribution phase is a phase where the institutions that were buying low on the market are selling and the retail sector is coming in. These corrections are nothing more than FOMO of the retail buying what the institutions are selling. So institutions are selling when we have this, let's say, top at 60,000. And as the institutions are selling, we can see how the retail market is coming in. These are the people that are unfortunately not very well versed and not very well informed about what we are talking today. And they are buying in thinking that the price will continue growing. Then we have the institutions selling again. Then we have the retail sector buying again. And obviously, these institutions actually win with a lot larger amounts of Bitcoin that they can sell and collapse the price to the next bear market bottom. What I'm trying to explain to you is that this is the psychology behind this range-bound movement, accumulation and distribution-wise, but we're going to explain it better when we talk about Wyckoff accumulation and distribution in our advanced video. For now, we need to understand how it works and we need to understand when we can actually determine that we are in an accumulation and distribution phase. Now, if we go down, let's say to a daily level, accumulation and distribution phases are not typical only for large, I would say in this case, time frames. It can be found on any particular level, on any particular time frame in the chart. We're going to be deleting this just not to confuse us. But for example, let's take this particular case. We can see if we start from, this is capitulation, it's a black swan event. This would be the first practically moment that we can say that we are currently in accumulation. Now this we need to mark in red. As we said, this is the accumulation phase. And as you can see, after the accumulation phase has finished, finally the price has gone out of this range. As you can see, there is several tries on the top and the bottom. It continued upwards. What did we say? After the accumulation comes distribution. Obviously, we can see this is the distribution phase. Now, once the distribution phase has finished, obviously people started selling. We are coming down to what? Again, to accumulation phase. Now, once the price have went out of this range downwards, we started creating this accumulation phase, which again reaccumulates the price before it starts going upwards again. And we can see that we have these kind of movements up, down, constantly, and we can find them all over the actual chart. What I'm trying to say is that in any place you can find these accumulation and distribution movements, and they are very helpful for you to know that the time for the price to be in this particular range has more or less finished, and for you to have an idea of what probability you have for the price to go one way or the other. But again, this is not the only indicator. This is just one out of many indicators you need to consider before making a decision about investing in trading. And always do your own research, always do your own analysis. Do not hope for somebody else's analysis to be right. And don't forget, after every 4 videos of different indicators and formations, we're going to be doing 5th or 10th or 15th video of test trading. We're going to show you how you can test trade on a chart, how you can practice your skills, how you can, I would say in the future, devise your strategy and try to use these, I would say, tools, informations, and indicators the way it's better for you. We hope that you enjoyed. This is more or less everything we have for today, just to explain to you how to determine the distribution and accumulation phases. Don't forget, this is just the start of our course. In the Macedonian channel, we have more than 160 videos of advanced course, and we're going to be replicating everything from that course to the English channel. We hope you will follow us. And again, don't forget to subscribe to Cryptoeconomics on YouTube. As well, find us on Twitter, Instagram, Facebook, and Threads. Thank you very much, and see you in the next video from the warm Malta.